Last quarter, JPMorgan booked $25 billion in interest income, bigger than America's entire space agency budget. Almost all came from the gap between what they pay and what they earn. Your high-yield account didn't beat inflation. It funded the bank that did. Let's walk the dominoes. The mechanism nobody puts on the chalkboard has a name. It's called net interest margin. The Fed funds rate is sitting at 3.75% today. Marcus by Goldman Sachs pays you 3.65. Bank of America pays you about 1 cent on every $100 in a regular savings account. The gap between what they earn on your money and what they pay you back is where the bank actually lives. Multiply that gap across the deposits sitting in commercial banks today. Federal Reserve data from March 2026 puts the figure at $19 trillion. 1 percentage point of spread applied across $19 trillion in deposits runs to $190 billion a year. Call it the deposit spread pump. It runs in the background whether you log in to check your balance or not. $25.5 billion. That's the net interest income JPMorgan booked in the first quarter of 2026 alone, up 9% year over year. The bank's chief financial officer, Jeremy Barnum, told analysts on the earnings call that the current rate environment lets the bank capture more of the spread. Older, lower-yielding assets are maturing on schedule, and the bank replaces them with new loans priced at today's market rate. Translation: your savings rate isn't moving up, but the bank's margin is widening every quarter. So how does that gap turn into actual profit? The bank takes the dollar you deposit and pays you 3.65% on it. Then it lends the same dollar back out as a mortgage at 6.8, a small business loan at 8, or a credit card balance at 22%. Even after losses on bad loans, the average commercial bank earns roughly 3 percentage points above what it pays depositors. On $19 trillion in deposits, 3% is around $570 billion. That's the entire profit pool of the American banking sector. Every dollar of it comes out of the gap between you and whoever the bank is lending the money back to. Here's the part the marketing department prefers you didn't sit with too long. When the Fed raises rates, the rate you get on your savings catches up roughly 6 months later. When the Fed cuts, your rate drops the same week. The Federal Reserve has cut 3/4 of a point since December. Every high-yield account followed in lockstep. SoFi went from 4.6 down to 4.5. Marcus dropped from 3.8 down to 3.65. Ally moved from 4.3 down to 4.2. The billboards calling them high-yield never came down. Just the rate behind them. If the Federal Deposit Insurance Corporation forces banks to play fair, why does the spread keep widening every cycle? The agency tries, just not hard enough to matter. It publishes a monthly figure called the National Rate Cap. The May 2026 release showed the national average savings rate sitting at 0.38%. Compare that to your account at Marcus paying about 10 times as much. Both accounts share the same federal backstop. Both come with the same coverage limit of $250,000 per depositor. A 100-fold rate difference based purely on which website you happen to click on the way in. I keep 2 accounts at the same bank holding company myself. One account pays me almost nothing. The other earns close to 3%. The only thing different between them is the address I used to open them. The bank knows exactly how this works. The bank designed it that way on purpose. Some customers shop around for rates while most never bother. The customers who don't shop are quietly subsidizing the customers who do, and the spread covers the marketing budget on top of that. If banks competed for deposits the way the textbook claims, the high yield rate and the regular rate would collapse into each other within a year. Instead, they live 100 times apart, paid out by the same vault, on accounts that share identical federal insurance. That isn't competition by any meaningful definition of the word. It's coordinated price discrimination, and the entire commercial banking sector runs on it. By now you're thinking, all right, fine, just move every dollar to the highest yielding account I can find and call it a day. That's exactly what the brokerage industry was hoping you'd land on. Because the second the Fed started cutting, every wealth advisor in the country switched their script. The high-yield savings account was suddenly old news. There was a smarter, higher-yielding alternative they wanted you to consider. And the alternative is where the actual robbery starts. The pitch begins with a phone call from your advisor explaining that your high-yield account is leaking value to inflation. Technically, the advisor isn't lying. Inflation in 2026 is running around 2.5%, and your 3.65 savings rate is barely beating it after taxes. So the advisor offers what they call yield enhancement. The redemption gate cascade is what that yield enhancement turns into the moment markets shift. The 4 products getting pushed hardest in 2026 all share one feature. They pay you somewhere between 5 and 9%. They look like savings products on the marketing page. Every single one carries liquidity risk that didn't exist in your federally insured savings account. Brokered certificates of deposit, retail business development companies also called BDCs, private credit interval funds, and structured notes wrapped as principal protected savings. Each one comes with a yield premium attached, and each one's yield premium is paying you for a risk you can't see at the moment you sign the paperwork. Take the retail BDC. A business development company is a fund that loans money to mid-sized businesses too small or too risky to get a normal bank loan. The fund pays out the loan interest as a quote dividend yield. In late 2025, the average retail BDC yield sat at 9%, almost 3 times what your high-yield account paid. The wealth advisor industry loved it from day one. Retail flows into BDCs hit a record in the second half of 2025. Then something cracked under the surface. 4.8% in a single quarter. That's the redemption rate the Cliffwater BDC index hit in the fourth quarter of 2025, up from 1.6 in the third quarter. Triple the prior reading inside a single 90-day window. The fund managers, suddenly facing more redemption requests than they had cash on hand, did the only thing the fund documents allowed them to do. They closed the redemption gate entirely. Blue Owl Capital, one of the largest private credit managers in the country, formally gated its retail BDC, ticker OBDC II, in February 2026. Investors trying to redeem were told they could no longer request additional withdrawals. The fund quietly switched from quarterly tender offers to quarterly return of capital distributions. Shareholders thought they were buying a yield enhancement. They had been buying a quietly illiquid product the entire time. That's the gate the wealth advisor never described in the brochure. Every retail BDC, every interval fund, every structured note product carries a version of it. The mechanism is always the same. The fund holds illiquid assets, mostly mid-market corporate loans. When too many investors ask for their money at once, the fund prorates the redemption or refuses entirely. Your money is still there in some accounting sense. You just can't get to it. The yield premium you collected was the bank charging you for liquidity, then keeping the liquidity for itself. Compare that to the high-yield savings account it replaced. The Federal Deposit Insurance Corporation guarantees up to $250,000 per depositor per bank. You can pull every dollar out tomorrow. No tender window, no redemption gate, no quarterly return of capital, no waiting period. The yield is lower because the liquidity is total. That's the trade you signed up for the day you opened the account. But here's the part the brokerage script skips entirely. Default rates inside the private credit market hit 9.2% by the end of 2025. The highest reading on record since the asset class started being tracked. $21 billion of BDC sector debt was set to mature in early 2026, and the wall of refinancing pressure was about to land. JPMorgan Private Bank published a research note in April flagging private credit as the segment with the largest tail risk inside retail portfolios. The note came from the same JPMorgan that owns half of the deposit spread pump on the other side of the building. The same investment bank pulling money out of federally insured savings is on record warning about the products they're pushing you toward. A pattern is starting to come into focus. The high-yield savings account is the lowest yielding, safest, federally insured product in the entire stack. The brokered certificate of deposit pays slightly more, but the issuing bank can call it back early. The retail BDC pays a lot more, but the gate can close at quarter end. The interval fund pays even more, but the redemption window opens once a quarter at the manager's discretion. The structured note pays the most, but the principal protection comes with a derivative counterparty buried in the fine print. Every step up the yield ladder is one step deeper into illiquidity. The wealth advisor's job is to walk you up that ladder one rung at a time. They earn a fee on every rung. The bank holds the gate at the top. When you eventually need the money out, you find out the gate is what you actually paid the premium for. So the math has been telling you something the marketing has been carefully obscuring. The federally insured account paying 3.65% isn't a bad product you should escape from. It's the only product on the shelf that's actually doing what it says on the label. Which raises a more uncomfortable question. Who decided this was a normal way to run an economy? And when did the high-yield savings account become a marketing category in the first place? The answer goes back to a single year and a single Goldman Sachs product launch. The year was 2016, and Goldman Sachs was about to do something genuinely unusual. The same firm that had spent the prior 8 years collecting public bailouts and getting roasted in congressional hearings decided to enter the consumer banking business. They didn't open a single branch. They didn't print plastic debit cards. They put up a website, named it after the firm's founder Marcus Goldman, and offered a savings account paying about 1%. At a time when the national average savings rate sat at 0.06%, 1% looked enormous. The high-yield brand premium had just been invented. Before 2016, the category effectively didn't exist as a separate marketing tier. Banks paid you whatever rate they paid you. There was no separate high-yield tier and no brokerage commercial telling you that your regular savings was leaking value. The online comparison sites ranking the top 10 online banks of the year all came later. Marcus's launch changed the marketing playbook in two ways. It proved depositors would move money to a website they had never heard of for an extra 100 basis points of yield. And it proved that the existing megabanks could keep paying their existing customers nearly nothing while offering a separate brand at a much higher rate. They could capture the deposit shoppers without dragging up the rate on the loyal majority. Within 18 months, every major financial institution had a high-yield brand. Ally already existed but doubled down on its rate marketing. American Express launched personal savings. Capital One repositioned 360 performance savings. Discover Bank started running television ads. Synchrony Bank, formerly the captive credit card unit of General Electric, became a top 3 high-yield destination. Citigroup spun out a separate website called CD Accelerate. The deposit base of the entire commercial banking sector got cleaved into 2 parallel tiers based purely on which marketing channel a customer happened to enter through. The financial press celebrated it as a win for the consumer. The banks celebrated it as a win for the bank. Both takes were technically right at the same time. The customer who shopped did better than they would have done in 2015. The bank kept paying nearly nothing to the 80% of customers who didn't shop. Net deposit costs at the 4 largest banks went up by less than 30 basis points across the entire rate cycle. The financial headlines, meanwhile, kept screaming that depositors had finally beaten the system. Now layer on what happened next. The Federal Reserve cut rates to 0 in 2020. Every high-yield rate collapsed to 0.5%. The brand still said high yield. The yield no longer was. Then the Fed raised rates back to over 5% across 2022 and 2023. High-yield accounts crawled back up to 4.5%. The gap between what banks earned on treasuries and what they paid depositors hit its widest level since the 1980s. Bank stocks roughly doubled across both years. Then in late 2025, the Fed started cutting again, and the cycle reset for the next round of marketing. This is the high-yield brand premium in action. The label always stays in place. The rate moves with the cycle. The bank's margin moves in the opposite direction at the opposite speed. The depositor is the only party in the room who can't reprice their position fast enough to win. A small personal aside on this one. I opened a Marcus account in 2018 when the rate was about 2%. I've left the money there ever since because moving it has always felt more annoying than chasing 50 extra basis points elsewhere. That decision has cost me real money over 7 years. The bank's customer retention department knows this exact pattern. They model it down to the basis point. The number they care about is something called the deposit beta. It measures how fast a bank's deposit costs adjust upward when the Fed raises rates. The lower the beta, the more spread the bank captures on the way up. JPMorgan's deposit beta during the most recent tightening cycle was about 37%. When the Fed raised by 100 basis points, JPMorgan raised your savings rate by 37. The other 63 were profit. If you've been keeping score, that's the entire engine. A 2016 marketing invention that lets banks segment depositors into shoppers and non-shoppers. A federal insurance scheme that backstops both tiers identically. A monetary policy cycle the bank rides up and down at different speeds. A brokerage industry standing by to escort the shoppers off the federal insurance reservation the moment savings rates compress. And at the end of the chain, a private credit market with default rates at record highs and redemption gates that close exactly when the depositor needs the money out. The high-yield savings account isn't the problem. It's the cleanest, safest, most regulated product in this entire pipeline. It's also the lowest paying on purpose, because that's what makes the spread game work in the first place. The advice to abandon it isn't financial advice. It's a referral fee in a more confident outfit. So the next time the wealth advisor calls and tells you your savings is leaking value, ask which BDC they're trying to sell you. Then ask what the gate looks like when too many people try to leave at once. Then ask who they think is going to be left holding the loans inside that fund when the next round of defaults clears. The answer rhymes with pension fund. The same machine runs $3 trillion through private credit. That's where it actually starts breaking.